This is actually a very high-powered panel, and it got higher because we have increased the size of the panel substantially and enhanced its value for you. The purpose of this panel is to talk about money, sources of money, debt, equity, quasi-equity, and then how to get the money through better, through wisdom, through policy reforms, etc. We have, let me count, 1, 2, 3, 4, 5, 6, 7, as I recall. We have 7, not counting me. As you know, Africa, the mood has changed a little bit, and I think Pradeep will talk about that. I want you to start, Pradeep, in a moment. The panel has 3 components: private equity, debt, stock market. Actually, those are 3, and then 4th is how to catalyze all of them through proper reform. So let me tell you about debt immediately, because I'm going to get my out of the way. I'm a financial beautician. I go to clients, mainly supranationals and banks. I pretty them up. I take them to the rating agencies so they look beautiful, and they get a good rating. Then they borrow in the markets, debt markets. Okay, very important, because for every dollar invested in the equity of a project, you need $3 or even more of debt to make it work. So we have had Bawade as a client, AFC as a client, EIDB as a client. Those 3 are the 3 of the 8 highest rated credits in Africa. To get a rating, you need to really prepare for it. Get an advisor, get advice, and I will dispense with how you do that. I'd like to turn immediately to the equity side. In the presentations, we have, unfortunately, only time for what we call elevator speeches. Pretend this is an elevator. So, Pradeep, please, if you could start with the game-changing sort of thing that happened 3 months ago, and then talk about what you do and lessons for new players that might bring in private equity.
Sure. I can't tell whether this is on, but
it is.
On? Okay, good. So I think the key thing that has changed in the last few months, compared especially to the 2 previous years, I would summarize as China, commodities, and currency. And I think the point that I would make about that is that many people tend to do 2 things which I think are dangerous. One is that they look at emerging markets writ large as a giant category where everything is the same, and there are very large differences within emerging markets. Not everyone is structured like China, not everyone is impacted equally by China. And I think the second thing that happens is that Africa is treated as a country rather than a continent with 54 odd countries, and I think at last count several thousand languages. So I think for people that are looking at it as an investment opportunity, and we've been doing that since 1993. We're a private equity investor. We've, in the last decade, invested in about 60 companies and exited about 28 of those, and remained pretty active. We have about $2 billion of exposure to Africa today, and really concentrated in Nigeria, Kenya, Ghana, and South Africa. I think the 4 or 5 points that I would make are that, one, for an investor, particularly in the private equity space, Africa is really 15 cities. It's not 54 countries, and even the 4 or 6 countries that people invest in, it's really 1 or 2 cities in those countries. That's where the opportunity set is. And those cities are very different from oftentimes the rest of their own countries. Typically, they make up 60% of the country's consumption, have per capita incomes that are 2.5 times the national average. And at the end of the day, when you're a private equity investor, you're buying a company. You're not investing in an entire country. The second thing is that different investment strategies have different risk profiles. Oftentimes I think people take the risk profile of investing in the most dangerous mine in the most dangerous places in Africa and pretending like that's the same risk profile as buying an ice cream company in the most well-governed, most progressive markets on the continent. And they're just not the same. And you get very different exposures from the public markets, from the debt markets, and the private equity markets as well. The third thing I would say is that as a result, being local is absolutely critical. We're of the opinion that you can't fly in and out of these markets, and you can't even really cover sub-Saharan Africa from one place. I think you really have to be in at least 4. And then the last 2 points I would make. One is that you shouldn't judge what's happening in Africa by what's happening just to global business brands. In many of these markets, local brands are as competitive, if not more competitive, than multinational brands, which is why you see multinational brands often buying local brands. And part of the reason for that is that pricing strategy and cost structure is really critical in these markets. And a lot of the global brands are carrying a very large cost structure due to expatriate labor. And the pricing strategies are often leaning actually more to the upper middle segment rather than the mass market where the consumer opportunity often is. Finally, the one thing that everyone should be focused on and should be thinking very aggressively on how to manage is currency. We've seen a lot of these markets see depreciation in the tens of percentage points in the last 18 months. It's something that we pay a lot of attention to. I wish I could tell you a lot more about how we do that. But to the degree that people want to talk about that, we can talk about it after.
They'll be after the sessions here. Okay, Ambassador Gibb, you are a new player on the block. You have come in with big marbles, $5 billion to be precise. So please tell us about Blackstone and how you will play with that, what segments you're in that Pradeep is not in, and how you will differentiate and add value.
Yeah,
and make money.
Hopefully make money. So I couldn't agree more with everything Pradeep said about looking at the individual countries, figuring out which are the right markets, and he sort of gave 3 C's. As we started working at Blackstone to figure out where the big investment were going to be, I was talking with Sean Klimczak, who leads the practice, and I said, somebody told me this, there's 3 P's to doing business in Africa, so to top your C's. And far and away the most important is people, and finding the right partners in team on the ground in Africa. So that was sort of goal 1 for us. The second, if you're going to do infrastructure, but I think anything in Africa, is patience, because these are young markets. It's going to take a while. And if you're willing to, people want to come in private equity and do quick turnarounds, I think it's not the right market. You've got to be there for a long time. And the third, and somebody else told me this and I loved it, is plan B. Because it's not going to go the way you thought it was. There'll be positive surprises and negative surprises, but you need to be able to look through those. For Blackstone, when we went in, the key was finding the right partners from the beginning. We were lucky enough to be able to partner with Aliko Dangote to do our work in Nigeria and get Lamido Sanusi to chair the board of Black Rhino. So we felt like we'd found the right local partners. We could bring Blackstone's global expertise in building energy and infrastructure to Africa and partnered with the right local partners who knew how to do business on the continent. Right now, we also brought in another partner, the Bafokeng, out of South Africa, in a group called MOGS that are some of the leading pipeline experts in the world. So we've really focused in 2 areas to this point. Nigeria, where we're looking at both power and a major pipeline, and Ethiopia, where we're looking at a major pipeline. Why those countries? The obvious answer is the market size is huge, the opportunity is huge, the growth rate is huge, and we felt like we had the right relationships to do business, and both with the government in Ethiopia, the government in Nigeria, but more importantly with the right local partners to be able to execute on those business plans. I think we're going to keep growing and looking for other opportunities, but it's interesting, and Pradeep hit on this, and the panel before talked a lot about it. I also spend a lot of time at Albright Stonebridge advising a whole number of American companies who are looking at Africa, and until we break down the barriers to trading between the continent, it really is a bunch of smaller markets, and quite often city markets, because even within countries you can't ship goods and make things work across the continent. I think the efforts that the panel before talked about are critical to opening up the markets and getting more and more investment.
Thank you very much, and Ambassador, for staying on time as well. I'm at a fork in the road. I think I'm going to go to the domestic equity side, the domestic debt side. So if you could pay attention to how a region with 8 countries is borrowing the capital markets, I think it'll be very, very interesting because domestic debt is a way to avoid currency risk that was mentioned. And from there, we'll go to international debt and take it to equity. So please,
Yes, thank you. Let me first start by...
Please introduce yourself briefly.
Exactly. By saying my name is Adrian Diouf and I'm from Agence Humour à Titre. First, what is Agence Humour à Titre? Agence Humour à Titre is a DMO, but not a common DMO. It's a debt management office for 8 countries. We have the challenges to issue debt. We are basically the issuance authority for 8 countries.
Both domestic and international?
Yes, both domestic and international. And those 8 countries are sharing the same currency and the same central bank. It's a monetary and an economic union, and that's why we can do that. That being said, let's say that we are issuing every year basically 3.5 billion USD locally, let's say 2.5, and international on the international market 1 billion. Where it comes from? Actually, it's a strong political will which has been taken a couple of years ago to put capital market at the middle of a development strategy. The countries has noticed one thing: they need a strong debt market, and if you need a strong debt market, you have to build it. So what they decided to do is to use the sovereign debt market to build a strong debt market based on the sovereign. Why the sovereign? Because to build a market, you need human resource, you need infrastructure, you need human capital, and only the sovereign debt market was able to provide, in terms of size, the critical size to allow all the actors to be sustainable. So the idea we have was to put all our efforts together, the 8 countries together, to build only one market, and we are issuing on a regular basis on that market. We are one of the most dynamic, maybe not in terms of size, but in terms of frequency, in terms of practice, in terms of modernization, taking new regulation in order to make that market more sustainable. But it's not just a political will, it's also a necessity. Why a necessity? Because a couple of years ago, with the crisis and everything, public aid went down, and all our countries were facing, at the same time, they were facing a need in terms of investing in infrastructure. There was no money for that, so they have to be innovative. Just to give you a number in terms of budget, capital market started 10 years ago, let's say 15 years ago, was 0% or maybe 1% in terms of budget. And today we are at 25%, and we won't be stopping there. We will be just taking more and more space in the budget. So basically that's the strategy. If you want, we can talk a little bit more about what we offer, how the market is structured, and how we can do what we can do to get you come in our market, because that's one of our challenges now.
Thank you very much, Adrian. It's very interesting, and I think one of the notable accomplishments of the region, the MOA region, is that BOAD, Banque West Africaine de Développement, actually a client of ours, has obtained an investment grade rating, the 5th highest in Africa, BBB1 Moody's, and BBB flat Fitch, and there will be a significant issuer in the markets in the fall, $500 million perhaps. We shall see. With that, I'd like to actually turn to somebody who does debt markets all the time, and perhaps you can talk about other things if you wish. But I would like to have Goldman Sachs, Colin Coleman, talk a little bit about broadening the issue of access to debt to help finance projects in addition to equity. And then anything else that you want to mention, but within a space of an elevator speech, if you like.
It sounds like a warning.
Well, so far I've not used the hammer, and I'm trying to avoid it.
Does my reputation precede me? Just kidding. Wonderful to be here. love being in New York, so any excuse to be here. Anybody invite me to New York, please. So what, if I can just say what's on my mind.
Sure.
I think, everything that's been said has been high quality. I think the problem with capital markets in Africa is that the truth is outside of South Africa, you're really talking about illiquid capital markets. So you're talking about illiquid structuring largely. I mean, there's sovereign bond issues. Ghana is in the market right now with a sovereign bond issue. There's many of the sovereigns that have gone for these bond issues, but the real issue is how are people financing the corporates and the entrepreneurs, and what is the access to capital markets. So just, the numbers are, and I watch it every single day on my screen, $800 billion on the Johannesburg Stock Exchange, trading $2 billion a day on the equity capital markets. The next biggest is Nigeria, which trades $20 million a day, and they have a $50 billion market cap, and the market caps are shrinking in dollarized terms as the currencies depreciate. So the only really, from a global capital market point of view for equity capital markets, public market trading exposure of the Wellingtons, the Fidelities, etc., is through the Johannesburg Stock Exchange as a means to play, like in the old days, Australian companies were the way to play China. That's very much the reality today. It's very difficult to get liquid exposure to Dangote Cement because he owns 92% of it personally, even though it's a $15 billion company. So how do you get liquid exposure that you can go in and out of to these kind of companies? So that's question one. Many markets like Angola that have been talking about creating equity capital markets that haven't got exchanges, then the governments are not issuing paper, they're not listing the state-owned enterprises. Many of the state-owned enterprise sector are the larger earners. Sonangol, for example, Unitel in Angola. These are the companies that we would love to have exposure to, but you can't get as long as they're not listed and they're held in close hands. So this is a problem. The second problem is convertibility of currencies. So it's not just the depreciation, but the question of ability to convert Naira into dollars, for companies to invest capital in some of these countries where it's very difficult to get the permissions to invest and then to get the money out. So it's a limitation on capital investment, and we've got a lot of companies who are effectively asking us to make complicated structuring trades in these countries to help them either finance capital because it's difficult for them to get money in, but it's also difficult for them to get money out. So this is an emerging problem. If you take Nigeria, for example, the fact is the Buhari presidency was fantastic news for a peaceful transition politically, but so far it's been very, very difficult to get fiscal and monetary progress in an administration that is waiting to have the full administration put in place. So this is a concern in a country as big and as important as Nigeria. And you get countries, like Ghana, for instance, which are issuing sovereign bonds, but the underlying fiscal health is, being questioned, and it's difficult to establish the sustainability, particularly in a time where we have the US Fed increasing interest rates, we have the commodity problem, and China's transformation from effectively an infrastructure and exporting economy to a consumer economy, which is effectively causing a lot of the slowdown in the commodity world, which is impacting these underlying fiscal ratios of countries like Angola or Ghana. So I just throw out there, I guess I've used up my 3 minutes, but I just throw out there these problems. I would say, we are seeing a lot of evidence of progress. So just using the simple 3 examples, Goldman Sachs helped IHS buy into MTN Nigeria Towers. We raised $2 billion. We helped raise significant amount of equity capital from sovereign wealth funds. and we helped them do that. That was a very large event. We also happened to be principal investors in IHS. We helped Helios sell part of their stake in Equity Bank. I see James Mwangi here. And there was significant interest in that situation. And we helped Actis sell Globalec for $750 million. It was announced a couple of weeks ago. So the private equity world is playing, Pradeep, a very, very important role. Don is involved in that. The sovereign wealth funds are playing an important role. Because of the liquid nature of these markets, those sources of private capital are going to play more of an important role. The key challenge to regulators is, come on, let's move faster in reforming the capital markets. Let's allow for indigenous capital markets. This is what China did. China had no capital markets. It's going through its own indigestion now, but effectively raised $300 billion from selling minority stakes in state-owned enterprises and helped reform their economy as a result. Very, very important contribution. We have to get on with it.
Thank you very much, Colin. I think we have gone naturally into the equity markets, and the issue you raised is the illiquidity of the equity markets in Africa. There are 25 or so. The only liquid being, you mentioned Johannesburg. I think we can ask the head of the Nigeria Stock Exchange, who is representing the Association of African Stock Exchanges, to respond to how they are trying to work together to enhance liquidity, to improve performance, to integrate, if possible, the market. So Oscar Onyema, please. Remember, we have an elevator speech time frame.
Okay, I'm not sure you can hear me. Can you hear me?
Yes, okay. You're fine. Thank you.
Yeah, the way we view the previous speaker's comments, you can look at the glass as half full or half empty. If you look at exchanges in Africa 5 years ago, 10 years ago, as compared to where they are today, there's been significant progress. Progress in trying to bring common standards across the region, progress in trying to have the listing standards benchmarked to global standards, progress in getting the exchanges to become members of the World Federation of Exchanges, which is a big deal for smaller countries because of the high standards. There's been a lot of deals that have been done as well. So progress in the sense that there's been a lot of IPOs. There's a lot that still needs to be done, don't get me wrong. And I do agree that the way to get more liquidity into African exchanges on the equity and on the fixed income side, because a lot of these exchanges are also offering fixed income listing and trading, is really by appropriate fiscal policies that support issuers, both corporates and other kinds of issuers, to list. For example, the way you structure your taxes, tax regimes, is very, very critical. From an ASEA perspective, the Association of Securities and Exchanges Association, the African Securities Exchanges Association, which I chair, we're looking to provide a platform that will be a strong advocate for using exchanges as a platform that is central to raising of capital, that is central for driving economic growth. And in order to do that, there's a lot of work that needs to be done with the leaders of the countries, so the presidents, the cabinet, and all, because I'm not sure that they truly understand the power of the capital markets in unleashing economic growth. And so that is very important. Another important thing we're doing is driving the linkage between major hubs in Africa, so Johannesburg, Nairobi, Lagos, Casablanca, in an effort that we're partnering with the African Development Bank. We think that it's important to have a way to, an easy and cheap way to get access to the biggest markets on the continent. It's difficult, like the previous speakers said, to view the continent as one entity, especially where you have 25 markets. And I'm not sure that you're going to see one market in our own lifetimes because of so many reasons, sovereignty and other reasons. So to wrap it up, I think that what we're trying to do is to create a marketplace that is compelling, have appropriate environment in place, the enablers that will make it attractive for large institutional investors from across the world to view markets in Africa with, in a favorable light, bearing in mind that liquidity begets liquidity. So if you have no liquidity and nobody wants to play, you will never have liquidity. You really need to start somewhere and then build it up.
Thank you very much, Mr. Onyema. Now we have set the stage. We have the challenges, the problems, and the accomplishments. So we are on the operating table. How can we do better? We can ask someone who has the money to make you take the advice, or we can go to somebody who purely advises. So I'll give you a choice. Which one do you want first? Let's go with Dana.
With the money first?
With the money first.
Wow.
Money
I was thinking
speaks.
about how to wrap here with the operating table, the 3 C's, the 3 P's. I won't try and attempt that altogether. My name's Dana Hyden with Millennium Challenge Corporation. We are a U.S. donor agency that was created under the Bush administration 10 years ago to be a different type of donor, very much focused on the private sector and on a different model of development. So MCC's model has a couple of key features. First of all, over a decade, we've invested about 65% of the portfolio in Africa. That's about $6.5 billion. We've partnered with 15 African countries. The average size of our investment is about $400 million. It is a 5-year investment, so 5 years pencils down. And most strikingly, we have invested 70% in infrastructure. So we repeatedly hear about the infrastructure needs to achieve all of both the regional integration as well as the growth projections, and MCC is seeking to make an impact in that regard. Another key feature that we were founded on is that it is important that there be governance standards in place. MCC has a scorecard that I urge you all to take a look at. We make our decisions in terms of investments based upon performance on the scorecard. But what we see increasingly as we go into our second generation of compacts and investments is that we are focusing in a single sector. Often that is the energy sector. And we're looking at both the hard and the soft infrastructure investments that are needed. So for example, we've recently signed a $500 million compact with Ghana that is solely focused in the energy sector. We'll be looking at the utility in particular, often the public good, which has less of a chance of attracting private capital. And we'll be looking at what is the regulatory environment, what's the tariff structure, what's the operating structure to help make that a viable entity. I think this is a unique feature and one that we are hoping to take to another level as we move into the next generation of MCC. And I will end with, very quickly, we're also looking to invest in regional compacts. Heretofore, MCC has only had bilateral investments with countries. We need authority from Congress, and we are seeking that authority so that we could help, and we've already seen in our investments, if we could have crossed borders, be it with roads, be it with transmission lines, be it with irrigation infrastructure, how we could have helped facilitate the regional integration needs on the continent. So the private sector is very much at the core, both from a policy standpoint of what we're trying to make our investment sustainable, but really looking what money can come in behind us to make a dent. I urge you to look at 2 things. First of all, the scorecard, where MCC is choosing to invest. And then second, those sectors that we are working in and what are the opportunities that are available there. So with that, I'll stop.
Well, thank you very much. I think so far we've spoken with money, or ranges of money. So now we're going to talk to somebody who speaks from above the fray. Mark Powell has experience in consulting with the best of the best, and now He's lending his expertise on how to do better in terms of infrastructure financings. What can you do to do it better? Please, Mark, it's all yours. And I appreciate your patience, and it's just last but not the least.
Thank you very much. I'm Mark Powell. I'm with PricewaterhouseCoopers, PwC. I lead the infrastructure strategy team in New York for the United States. And you may say, okay, so why are you here then? Am I here? Because my clients are investors in infrastructure. So I'm not that remote from the money. My clients are big infrastructure funds, big sovereign wealth funds, who are sitting on a lot of dry powder right now, hundreds of billions of dollars, looking to invest in infrastructure because their clients appreciate the stability of infrastructure investment. So you hear that, to say infrastructure opportunity Africa, yes, very big. Stability of infrastructure investment in Africa, maybe a little bit less so. So how do we think about that? And I like to think about a parallel, right? A step back maybe 10 years ago or so in Latin America, where Latin America was going through a similar boom with its infrastructure investments and with funds looking to deploy their capital over there. Many things, and we've talked about, right, the risks of legal stability, the risks of counterparties, and the like. And I think this is not new, and this is something that governments need to do and need to ensure the possibilities, right, through public-private partnerships, to have structures that bring foreign capital, but that require an element of confidence in the rule of law, if you want, in the fact that 10 years, 20 years, or 30 years down the road, a concession is still going to be valid and on similar terms than the one that you agreed to. I will point out one thing that we have seen in Latin America and that we're seeing in South Africa right now that's unusual for a large accounting firm like ours to get involved with, but that is very significant. In countries like Africa, like Latin America, most of the investment opportunities from an infrastructure fund perspective are greenfield investments. So you need to build something new road, new bridge, new airport, new port. In order to build it new, there's a complex web of partners that need to be involved. Many of those local partners with ability. The notion of controlling the risk from a financial investor's perspective is typically something that you pass on through contractual structures to your partners, right? So you will say, okay, I will put the capital in, but you are responsible for delivering on time and on cost on this build. And this is important because that's what the terms of the concession require, and that is what provides us our road to revenue. Very often in Latin America, certainly, there has been some strong or possible misalignment of incentives. And sometimes, right, jokingly, people used to refer to it as the brother-in-law conundrum, right? You have a partner, the CFO of the company is a joint investor in the project with you, but at the same time, right, is very interested in making sure that his brother-in-law's company gets a large share of the contracts, and therefore that that some of the profits are in a way transferred to another entity than the one that you're dealing with. So we've developed a practice, and that's a caricature, of course, but we've developed a practice at PwC around construction risk, understanding, identification, and management, where we go in as an agent for some of these investors and help them really get into the weeds of projects through metrics, to identification of risk drivers, to monitoring, to interpretation of what is going on actually in the actual bids, so as to make it more easier for the financial investors to participate and to reduce from their vantage point the risk of non-performance by one of their counterparties that would potentially make that investment difficult. So I like to talk about it as de-risking of investments. Of course, you can never de-risk an investment,
Mark,
but lowering the risk of investments.
The elevator door is about to shut.
So that's it. So what can multilaterals do? I don't know. Supporting these types of services, I think, could go a long way. Thank you very much.
Thank you very much. I think you have heard a very rich discussion. Frankly, it's a pity that we had no time for questions. I will ask one last question, yes or no. Have there been any IPO exits from PE investments in African markets, in African stock exchanges?
Yes.
Yes.
Including from abroad.
Very good. I think that's a conversation you can take on, because that means that the equity markets are providing some exit options. That's very good. Thank you very much, everyone. My apologies for a fast process through this, but we are in an elevator, so what can you do? Thank you.
Doing business in Africa. You can't afford to be without Africa Investor.